Welcome back. We're in conversation with analyst turned fund manager turned author Devina Mehra is with us. And we're talking about her latest book, Money, Myths and Mantras. Devina, you also sort of advocate a hairish approach, H-A-R-E.
Right.
Instead of a buy and forget, right? Kind of an approach. Why is that and what does it mean really? I mean,
Okay, so first
looking for the exits constantly, or is that what it means?
No, I mean, see, being the hare is our mascot, our company mascot, and the reason we have the hare is because a hare is very agile, very fast, but it can also change direction very fast.
Right.
And also, it has 360-degree vision, which is what you aspire to.
Right.
So that was the reason we picked the hare. And hare, as I said, no theme lasts forever. So always we reevaluate all that we hold in either our PMS or our global funds every quarter from base zero. Because one of my...
But a viewer who is watching, is it possible for the lay investor? I mean, you know, somebody who does who's working 9 to 5 and is investing money for the long term.
Okay, so in that case, I would say, first of all, what is the long term? You look at the original Sensex list. What did it have? It had paper, textile, shipping, all of which have scrolled off. Or it had Premier Automobiles, Hindustan Motors, it had JK Thapar Group, Mafatlal Group, all of those. So what is a blue chip at a point in time? Itself changes. You look at the Sensex and Nifty, at one point there were no banks in it. Now banks dominate. Banks and financials dominate. At one point it was full of PSUs, ONGC, VS.
Just as an example, if you invested in the index, you essentially got the returns, I mean, despite all the shuffling over a 25-year period, you got 12-13% kind of compounded returns.
Yeah, 12-13%, yes. But I'm saying that people, so that's why I have a chapter there saying, should you be a do-it-yourself investor in the first place? Because as you said, you have a day job, you are not doing this full time. So look at your track record as you would look at the track record of any fund manager. And do you want to give 100% to this fund manager, which is you? Probably not. But you still want to be involved, you want to be able to talk at parties, then give some, keep some play money, maybe 10-20% of your corpus, but use professionals for the rest. So because, I mean, the value to my mind an active fund manager adds is risk management. So typically you will find most investors or fund managers talking about how they pick stocks to invest in. Very rarely will you find anyone talking in depth about risk management or when they sell. So always quiz your finance professional on that, not just how you buy, but how you sell.
Absolutely. Be the house, not the gambler is another one of the mantras that you highlight. I mean, what does it mean for an investor, Devina? How does one do that? And what does it mean, really?
Yeah, it means because in a casino, the casino has an advantage. So let us say in roulette, they have a 1 on 37 advantage because if the ball comes to 0, no one gets any payoff. So on a 1 or 2 turn basis, you might get that advantage, you might win. But because there are so many runs, the casino will always win. So always make sure that, that investing is a game of skill and luck. So you have to maximize the skill factor and minimize the luck factor, because the luck can favor you one time and not favor you another time. So always look at that aspect. And I mean, almost anything in life other than chess are a game of skill and luck. So that is why, for example...
How does one do it?
So for example, we have a diversified portfolio. So that's one of the things, that you don't have too much skew towards any one sector or any one stock. So diversified doesn't just mean the number of stocks, because even if you have 20 stocks and they're broadly in, 3 industries, it's almost like having 3 stocks. So those are the basic risk management, that have it diversified, have a stop loss. So those are some of the things you can do at your individual level. But most important, think about what kind of companies you want to buy. What is your criteria? Because often people might say, this kind of growth I want, this kind of return ratio. But when you look at their actual portfolio, those stocks are not the stocks which have those characteristics, because what you have done is you bought something recommended by a friend, something you saw on TV, something in a Telegram group.
Suddenly you have these bunch of stocks which are completely different from what your objective is.
Yes, or what you said your criteria was.
Devina, you say that in the book you write that stocks are like buses or trains, if you wish. There's always another one coming, the next one coming, right?
Yeah.
The FOMO has been such a driving force in these markets because everyone is chasing returns, everybody's seeing the next guy make money. That's a powerful impulse to fight.
Yeah. So, I mean, this is one of my favorite Richard Branson quotes, that opportunities are like buses and there's always another one coming along. And FOMO is very hard-coded within us. That's the thing, Prashant. A lot of things, our brain is not optimized for investing at all or for the good of our portfolio. It is, it evolved with two objectives, survival and procreation. And you asked about this FOMO. This FOMO is so deeply embedded in us precisely because in our hunter-gatherer days, if you got thrown out of the tribe or you went out of the tribe, you definitely could not procreate, you probably could not survive. So we are the progeny of people, yeah, we are the progeny of people who chose to stay with the tribe. So that staying with the tribe instinct is very strong. However, in the markets, if you chase whatever has done well of late, whether it is a theme, whether it's like whatever, defense stocks, PSU stocks, your small cap, or whatever, gold now. So if you chase whatever has just done well in the recent past, you will systematically underperform. This is data. So in fact, I often say that if you want an easy thumb rule on where there is froth in the market, look at where the new fund offerings are coming, because that's almost always the peak of that cycle. And that's not true just of 1 year. If you look at year 2000, a lot of tech funds were launched. Yep. You look at 2021 in India, you had a series of NASDAQ funds. So you are always chasing what has done well recently, and that's always a losing strategy. So those are the things you must keep in mind.
Devina, you had a long journey starting on the sell side, servicing institutional clients, then on the buy side, managing money, going global. I mean, you've seen a long sweep of history as far as Indian capital markets go. What do you wish you knew back then that you know now?
A whole lot of things. I didn't know much back then because the securities research as a business did not exist till 1993, till the market was opened up to foreign institutions. In fact, that was the trigger for me to start this business, saying now the market will professionalize. But even when I was doing my MBA at IIM Ahmedabad, there was no course on securities research because that career did not exist. So I've learned it all along the way. But I would say one of the sort of counterintuitive things is that what defines a mistake. In theory, again, you know that this is a game of probability, of ambiguity, because you don't know the future. And that's one of the first things I used to teach analysts, because I only hired freshers in research. That in studies you have that one question has one answer. Here there is ambiguity. But even so, it took me a long time to kind of think that what is a mistake, because earlier you thought a mistake meant something you said this was a buy and that stock didn't do well, or you said this was a sell and the stock actually went up. But now you realize that since everything is a game of probability, the outcome doesn't necessarily tell you what is a mistake. It should be whether your decision process was right or wrong, because sometimes low probability events happen. So for example, people will think that if you didn't buy Apple in the initial years, you must have been a dodo. But the fact is, for 20 years, Apple gave no return. I mean, 17 years, zero return. Even 20 years, the compounding was some 2% when US interest rates used to be many times that. And even after Steve Jobs came back, for 7 years, every year it was marginal profit or marginal loss. So it was not as if that, and it came close to bankruptcy. Amazon came close to bankruptcy, so did Tesla. So sometimes they could just as well have gone bankrupt. So that's the whole point, that you have to evaluate the decision process. At times I have made a lot of money on something which was patently a wrong decision. Something else happened to change the fortune of that stock, but the decision was wrong. And so also I have heard some of the big names saying, some stock got stuck because in the physical days, because I wanted to sell it, but I couldn't sell it because signature differs ho gaya, and then I made a lot of money on it. So, so both here, the point is that, again, we are hardwired that for our successes, we credit ourselves. And when things go wrong, we are looking for villains. that this management chore hai, operator ne chala diya, central banker ne ye kar diya. But both in successes and failures, there's an element of luck. So always remember that.
Devina, it's a fantastic book, I must say. I've gone through it. Money, Myths and Mantra. And I think the viewers will enjoy it, as they will our conversation as well. Thank you very much for dropping by and talking to us about it.
Thank you for having me, Prashant.
Well, enjoy the book. Check it out. Thank you very much for staying with us.